Real estate, a powerful engine for wealth, but it can be complex, costly, and illiquid. That's where REITs come in. Real estate investment trusts. They offer a simpler path to real estate riches. REITs allow you to invest in large-scale properties. Think shopping malls, office buildings, and apartments, all without the headaches of traditional ownership. You benefit from real estate appreciation, and you receive regular income. All this with less capital needed up front. This guide will be your roadmap to understanding REITs. We'll explore the basics, the benefits, and how to get started. Get ready to unlock the potential of REITs. It's time to build your wealth, one brick at a time. Unlocking real estate riches. REITs are companies that own and manage income-producing real estate. They operate like mutual funds for real estate. Instead of buying stocks, you buy shares of REITs. These shares represent ownership in a portfolio of properties. REITs generate income by renting out these properties. They then distribute this income to shareholders as dividends. This makes REITs a great option for passive income. REITs are traded on major stock exchanges. This makes them easy to buy and sell. They offer greater liquidity compared to traditional real estate. With REITs, you can access the benefits of real estate without the hassle of being a landlord. Not all REITs are created equal. They are categorized based on their investment focus. Let's explore the main types: equity REITs. These REITs own and operate income-producing properties. They generate revenue primarily from rental income. Think shopping centers, office buildings, and apartments. Mortgage REITs. These REITs provide financing for real estate projects. They lend money to property owners or invest in mortgages. Their income comes from interest payments on these loans. Hybrid REITs. These REITs combine elements of both equity and mortgage REITs. They own properties and engage in lending activities. This provides a diversified approach to real estate investment. Understanding the different types of REITs is crucial. It allows you to align your investment with your specific goals and risk tolerance. REITs operate on a simple principle. Investors pool their money by buying shares of a REIT. The REIT uses this capital to acquire and manage real estate assets. These assets generate income through rents or mortgage interest. A significant portion of this income is distributed back to shareholders. This distribution comes in the form of dividends. REITs are required by law to distribute at least 90% of their taxable income to shareholders. This makes them an attractive option for income-seeking investors. REITs also offer the potential for capital appreciation. As the value of their underlying real estate assets increases, so does the value of REIT shares. This dual benefit of income and potential appreciation makes REITs a compelling investment vehicle. REITs, or real estate investment trusts, offer several advantages over traditional real estate investments. These benefits make them a valuable addition to any diversified portfolio, providing both stability and growth potential. Let's delve into a few key advantages. First, diversification. REITs provide access to a wide range of property types and geographic locations, from commercial buildings to residential complexes. This diversification helps to mitigate risk by spreading investments across different sectors and regions. Next, liquidity. REITs are traded on stock exchanges, making them highly liquid assets. Investors can easily buy and sell shares as needed, providing flexibility and quick access to funds. Then, stable income. REITs are legally obligated to distribute a significant portion of their income as dividends, often resulting in attractive yields. This provides investors with a regular stream of passive income, which can be particularly appealing in uncertain economic times. Also, professional management. REITs are managed by experienced real estate professionals who bring expertise and efficiency to property management. These experts handle property acquisition, management, and tenant relations, ensuring that the properties are well maintained and profitable. Lastly, accessibility. REITs require a lower initial investment compared to purchasing physical property, making them an attractive option for new investors. This makes real estate investing accessible to a wider range of investors, democratizing the opportunity to benefit from real estate markets. Both REITs and traditional real estate offer exposure to the real estate market, allowing investors to benefit from property appreciation and income generation. However, they differ significantly in their characteristics. Let's compare them in detail to understand their unique advantages and disadvantages. In terms of liquidity, REITs are high, allowing investors to buy and sell shares easily, while traditional real estate is low, often requiring months to complete a transaction. When we look at accessibility, REITs are also high, as they can be purchased through stock exchanges, whereas traditional real estate is low, often requiring significant time and effort to acquire. Regarding management, REITs benefit from professional management teams that handle all operational aspects, while traditional real estate is typically self-managed, requiring personal involvement and expertise. As for income, REITs provide dividends, which are often distributed quarterly, and traditional real estate offers rental income, which can be more variable and dependent on tenant occupancy. Finally, capital requirements for REITs are low, making them accessible to a broader range of investors compared to high for traditional real estate, which often requires substantial upfront investment. REITs excel in liquidity, accessibility, and professional management, offering a hassle-free way to invest in real estate without the need for direct involvement. Traditional real estate, while requiring more capital and management, provides direct control over the asset, allowing for personal decision-making and potential for higher returns through property improvements. The choice between REITs and traditional real estate ultimately depends on your individual circumstances, risk tolerance, and investment goals. Both have their own set of benefits and challenges. Investing in REITs is similar to investing in stocks. Here's a step-by-step guide to get you started first. Research and education. Learn about different types of REITs, their investment strategies, and historical performance. Second, open a brokerage account. Choose a reputable brokerage firm that offers access to REIT investments. Third, fund your account. Deposit funds into your brokerage account to start trading. Next, select your REITs. Research and select REITs that align with your investment goals and risk tolerance. Then, place your order. Buy shares of your chosen REITs through your brokerage account. Finally, monitor your investments. Regularly track the performance of your REIT investments and make adjustments to your portfolio as needed. Choosing your REITs. Finding the right fit. Selecting the right REITs for your portfolio requires careful consideration and a strategic approach. Here are some key factors to evaluate when making your decision. Property type. Consider the type of properties the REIT invests in, as this can impact your returns. Do they focus on residential, commercial, or specialized properties? Each type has its own risk and reward profile. Geographic location. Evaluate the geographic diversification of the REIT's portfolio to mitigate regional risks. Are they concentrated in a specific region or spread across multiple markets? Diversification can provide stability. Financial health. Analyze the REIT's financial statements, including revenue, earnings, and debt levels to assess stability. Dividend history. Look for REITs with a consistent track record of paying dividends, as this indicates reliability. Management team. Research the experience and track record of the REIT's management team, as strong leadership is crucial. By carefully evaluating these factors, you can select REITs that have the potential to generate consistent income and long-term growth, ensuring a well-rounded and resilient investment portfolio. Managing your REIT portfolio tips for success. Once you've built your REIT portfolio, it's important to manage it actively. Here are some tips for success. Regularly review performance. Track the performance of your REIT holdings on a quarterly or annual basis. Rebalance your portfolio. Adjust your REIT allocations over time to maintain your desired asset allocation. Stay informed. Keep up to date on market trends, economic indicators, and industry news that may impact REIT performance. Consider tax implications. Consult with a tax advisor to understand the tax implications of REIT investments. Seek professional advice. Consider working with a financial advisor who specializes in REITs for personalized guidance. REITs and taxes. What you need to know. REIT dividends are generally taxed as ordinary income. The specific tax rate you pay will depend on your individual income tax bracket. It's important to factor in these tax implications when evaluating REIT investments. Consult with a qualified tax advisor to understand the tax implications of REIT investments in your specific jurisdiction. They can help you optimize your tax strategy and minimize your tax liability. Conclusion: building wealth with REITs. REITs offer a compelling avenue for investors seeking to participate in the potential of real estate. They provide diversification, liquidity, stable income, and professional management. By understanding the basics of REITs, conducting thorough research, and following a disciplined investment approach, you can harness the power of these investment vehicles to build wealth over the long term. Remember, investing in REITs is a marathon, not a sprint. Stay informed, stay patient, and watch your real estate portfolio grow.